Hello, everybody. This is myself, Carson Herlean, and my father, Greg Herlean. We're here in Southern California where we live, reside, and we work our businesses. We are loving life right now. It's beautiful outside. We do this podcast outside every time, and
every once in a while.
Every once in a while, not every time. You're right, and it's beautiful today. We talk all things with our life, business, which is mainly real estate, and to controlling money and teaching people how to do that. I focus a lot on the insurance business as well. And we like to share our thoughts together in this podcast about all these different money topics from his perspective and mine. And today we have an interesting topic for you guys. We're going to go deep into insurance products in the life insurance world. I will say that I've been in the insurance industry for probably 4 years-ish. My dad was in the insurance industry 20 years ago and kind of left and has been around it for a long time, so he knows a lot about it. And so we want to talk about all the different products you can buy, why they're made, how you can use them and for what purposes. And I think maybe a deep dive into these few products will be helpful for you guys when we talk all about, different things in the money world. And so I wanted to start by asking my dad, what are your thoughts, or not thoughts, but what is your understanding of maybe the different insurance products out there? Because, there's term insurance, which was the first insurance product made. Then there's whole life. And then since then, more products have spawned off of that, such as universal life insurance. And then from there, that spawned equity life insurance and indexed life insurance policies. And now today, there's products where you can do different premium financing and leverage on life insurance. It's a whole thing. So from your perspective, what are your thoughts on these different products and what are your understandings?
Well, look, I would say it should be a good conversation for most of you guys to listen to and understand or talk about. I'm an expert in space because I've been paying for life insurance for 25 years. So I started with term in my early 20s because I did it primarily to make sure that if I were to pass away that, the kids would be taken care of, and it's what I could afford. So that's where I started.
Yeah.
That being said, I've been reading a lot on different insurance products, and they're interesting, right? And so I really do think it depends upon where an individual might be at.
Yeah.
If what kind of policy. So like term, like you said, it's for a term. It's fixed typically. There's other types of term as well, but in general, it's a fixed payment. It ends at a certain period of time. You can always convert it. So if you're listening to this, you have a term policy and you want to convert it to something longer, most companies allow you to do that. The issue is you'll convert it based upon the age that you convert it. So like, let's say I bought a term policy when I was 25 years old and my premium was $200 a year. Well, now I'm 45, so I can convert it so I can keep it. Let's say it was $1 million policy, but now because I'm 45, I want to convert it to universal or whole life. It's going to go up tremendously, probably to $1,000 or $2,000 or more a year. So it's going to 10 times, but it could make sense, especially let's say if you're an individual who's not insurable anymore, meaning let's say that I became sick or I've been having sicknesses, etc. You don't want to have to go out and reapply because you'll get rejected. So anyways, there's universal and there's term and variable. Variable is tied to the stock market, and so you actually can lose cash value in your policy because it's variable. It's in the stock market. Universal life is tied to an index, like an index S&P 500, the Dow Jones, but it's typically the 500. But there's usually a floor, meaning it won't do less than 3%, but it could do more because it's tied. Your cash values, monies you're putting into the policy are tied to the stock market. So there's some definite benefits of both, and it really depends upon what you can afford and what you're going to use it for. We didn't talk about whole life, which is what you talk about all of the time, because I feel like the way whole life is set up, at least the way that you do it and the way you've taught me to do it better in my life, is use it truly as a bank account, not focused on the death benefit. I don't ever ask, hey, if I want to, if I have $100,000 and I'm like, hey, I want to put it into an insurance policy, a question I will never ask is, well, what is my death benefit? Now, of course, that is a benefit, of the whole life
It's a
policy.
question. Yeah.
But most people, when they buy life insurance, that's the first question they ask is how much is the life insurance death benefit? And so I want the least amount of death benefit because I want the most amount of cash, money going into cash. And so anyways, recently I've kind of read more about some of these things. I also read more about the index life insurance policy, with things I've forgotten about, like a mutual fund company. So a mutual fund, I assume you know this better than me, but I forgot about this. So like insurance companies that are owned by the stockholders, like owners of the company, and they benefit that.
Yeah.
There's also ones that are owned
Mutually owned by policyholders.
and so there's dividends. So if the company makes money, dividends will go out to the policyholders, which could be a credit to your account or cash, a check actually that goes out to the policyholders. That's pretty cool too. So there's just so many different types of insurance policies, which I think leads to, I'm obviously will ask you because I know you've studied this way more in depth than I think I ever have. But like caveat always to this conversation is meeting with an insurance agent who's not biased. I think that's one of the most important things, and I'll stop talking, I'll pass it to you. But what I've learned in my past in life when it comes to life insurance is life insurance agents typically, when buying it for death purposes, only sell a certain type. Even though there's so many different options, they don't sit down with you and say, hey, Carson, here's the different kinds of options, and here's why I recommend this one over these other 4. Typically they say, buy this policy, here's why, here's death benefit. So anyways, you know more about some of these, so your thoughts on these policies as well.
Yeah, and that's just that's a good breakdown of the insurance products out there and why you'd want to use certain ones, or not maybe why, but different ways they can be structured. So thank you for that breakdown. I'm curious too, when was the 401k invented, the idea? Was it the 70s?
Oh, I don't know. I think longer
60s?
than that. Yeah.
I know the Roth IRA was invented in like 98 or something.
Yeah.
So
much earlier or
later.
Recently.
So I bring that up because in life insurance for the longest time, for 100 plus years, was meant for a death benefit. However, I feel like wealthy people started to realize what you could do with life insurance because of the tax-free environment it was in and still is in, and because of the ability that the life insurance is protected against lawsuits or liens or the market crashing. It's a safe vehicle for money to be stored. A lot of, I think, wealthy individuals and wealth managers started to incorporate life insurance into their portfolio. But that wasn't really something for the public because it required a long time for money to be available, and no one just had millions of dollars that they needed to hide somewhere. And I think people in the 40s, 50s, 60s started to teach that you could use life insurance not just as a death benefit, but as an asset class to store your money. And this is not just for wealthy people. But as that started to become popular, 401ks came out, and then IRAs came out, and people then had to compare, well, do I have to put, or should I put money in this retirement account that's tied to the market, or should I put in a policy? And you can see, just based off of numbers, that a policy is not going to produce as high enough returns as those investments will. And so people started shifting away from the life insurance world and shifting more towards the retirement world. And I think we've come to a point over the last 10 years, I'd probably call it, where insurance products are coming back and they're becoming a lot more useful, and insurance carriers want to be selling these products, and so they're structuring policies more for the consumer and allowing people to have access to money faster, allowing better loan terms, and advertising it so more people can start using it as an alternative retirement type plan.
One thing you shared at the last event you and I spoke at, I thought was an interesting stat. What was the stat about banks that invest in insurance companies?
Well, they have their own policies. Is that what you mean?
Yeah.
So banks are required to have a certain type of capital and amount of reserves, and it's called Tier 1 capital that banks have to have, and they use life insurance as their Tier 1 capital. And I think between like Wells Fargo, JP Morgan, and like Citibank, or maybe US Bank too, there's over $70 billion in cash value life insurance between those 4 banks. And it's because banks know the protection that whole life insurance provides. And banks are using whole life insurance. They're not using anything indexed, anything variable or universal. It's all whole life.
It has to be guaranteed.
Because it has to be guaranteed. And so, but yes, they have $70 billion in whole life insurance.
Yeah, and I think that's powerful, and I think something that I wanted you to share, because I think one of the greatest things that most of my friends or people talk about is, hey, someday let's own a bank. And by the
Yeah.
way, I like this idea. I think owning a bank, but I think what's missed is most people don't know that banks put a decent chunk of money
Yeah.
into insurance policies
Yeah.
because it is safer, in my opinion, than
Yeah.
the FDIC insured. I mean, it's
I agree.
safer than the government.
Yeah.
They have one-to-one in assets.
Yeah.
Insurance companies are the strongest out there. And I think what's cool about insurance companies, which is really weird, by the way, when you talk about insurance, most people like get turned off. It's like mentioning taxes and the IRS. No one wants to talk about those things. But these insurance companies, the more I read about them, they've gotten more and more creative.
They have.
In particular about deposits you put with them
Yeah.
that are taxed, that have some good tax benefits.
Yeah.
And so I think individuals here that as you're listening, if you're looking for guaranteed, there's only like a few things you can say in life as far as investments go and use the word guaranteed without like going to jail.
Yeah.
And strangely enough, investing in a whole life insurance policy, you can use the
You
word
can use it.
guarantee.
Yeah.
And so I would say that's definitely something that you should consider and that others should consider. When looking at your portfolio, you should be looking at banking some of your bankable money.
Well, before you even
insurance
say
policies.
that, I'll preface it with, like, you mentioned it. You have to make sure you're setting up the right policy with the right financial advisor and an agent, and it's all set up correctly. But what does correctly mean? And I think I've come to understand, especially lately, it's like there's no correct way to do it. Every option can work. It's how can it's if you understand it, you'll probably maximize how it can be used. And so whatever product you understand will probably make sense for you to use. And financial advisors, like you said, they all have their own agendas too of what they want to push and what they want to make money on. And so you do, as the consumer, need to have some education on it and do your own research on it. And then when it comes to the products you select, like you said, it's very dependent on the situation. But I feel like I was very kind of that agent way where, like, I'm only selling this for this reason, nothing else works. And my mind has been open to, like, no, all these products work for different reasons, and you shouldn't bash any of them. They were all invented and are sold because they do something successfully. So they're all great in their own way. It's just some might be used for other things and some aren't. And maybe you don't like how agents or advisors sell it because they might be selling it in a way that's misleading compared to other products. And that's where all the confusion and the stress is in the financial industry. It's who's misleading who and who can get the better agent, who can get the deal, who can get the money on their side. And it's super competitive. So you do need to be careful with what you're getting. But what were you saying beforehand? I was going to tie it to that. I forget.
Well, investing in insurance companies, putting money in insurance policies, and there's tax benefits. I mean, but let me play off what let's talk about what you just said for a second. I mean, one thing I've bought in the last 5 years is I have bought another term policy, but I bought it for the purpose of key man life insurance policy.
Yeah.
So my partner, who's almost 70 years old, and myself, we wanted to have something in place if one of us passed away, that the burden, let's say that he passes away, he's almost 70, right? And he's very healthy. He'll probably outlive me, by the way, but let's just say that he were. I don't have the funds just to pay out his estate to buy his stock, and nor do I want to be partners with his estate. And so a term policy that's affordable for someone who's 65, 70 years old, it's the right move. So again, every circumstance is different. If it's for banking, if it's for key man policies, if it's for estate and tax purposes. I mean, premium financing is a whole nother conversation we're not going to dive into today, but it's very interesting, these different topics. And so understanding insurance, using it to your advantage, not getting taken advantage of. And I'd say one other thing that when it comes to insurance, I don't know the stat anymore, but I remember back 25 years ago, one of the stats that I used to share is that I think it was 94% of all policies either lapse or get or people cancel
Expire.
and they go into a different policy within like 5 years.
Yeah.
It's like most policies either lapse or they cancel and get a new policy. And so it's
isn't that interesting?
It's something you need, but I think is ever changing.
So back to the topic of different insurance products. It's a hot topic out there. Yeah, you say hot topic a lot, but this actually is a hot topic. It's IULs versus whole life to do banking with. And it's a hot topic. There's so much beef around it right now. But for you guys to understand these different these different
So
products.
indexed universal life policies versus whole life,
Yep.
IUL.
Yep. And an IUL policy, it's actually very creative what these insurance companies did. Somebody was like, hey, well, I buy term, I invest the difference, or I have whole life, but I want to also leverage the market gains and the upside the market gets. So how can I build a product to do that? And they built a product in 2004 or 5 or something, somewhere around there, where basically it's a product where you pay into the policy. Say you put in 10 grand. It has renewable term insurance. So every year the cost of term insurance increases. Does that make sense?
Yep.
And then after the cost of insurance is paid for, the death benefit's paid for, everything else goes to investments. It goes about 80% of the money goes into bonds to offer a floor, and 20% of the money goes into call options in the market.
Yep.
I didn't know it was call options until recently. It's call
It's aggressive.
options. It's not just the S&P, it's call options.
Mm-hmm.
But that's how the insurance companies can offer.
But that's what they invest their money in. It's not what your...
No, it's what the insurance. So you pay all the 10 grand in for the premium. The insurance company sets aside $500 to pay for the or $200 to pay for the death benefit,
yep.
and the rest they put in their general fund and they invest it.
That's right, but you're tied to, correct me if I'm wrong,
The whole
your
life.
funds are tied to...
Yes, we'll do that in 2 seconds.
Yeah.
So the indexed universal policy, they take your money, they invest it, and most of the money goes in guaranteed returns and 3, 4, 5% bonds to offer the 0% floor. But then the rest of it goes into call options so that they can capture the upside of the market. And so the idea is you now have a life insurance policy where you get to get the upside of the market, but still have the tax-free growth, still have a death benefit and all that. And I feel like the product is actually it's built pretty cool. I like it. I think it can be a powerful alternate to a 401k even, but there's downsides to it as well that most people who sell those products don't talk about. And it's a lot more risk involved compared to normal life insurance. And so that's why I tend to not use IUL policies, but I could see a situation where they could use it if it made sense.
What's the risk? You said there's risk involved.
So
It's not going to be as...
let's say there's a 0% floor and this year the market's down 10%. Let's say the IUL produces 0%.
Yeah.
That still means you have to pay for the cost of insurance.
Right.
So you still have to pay for the term, and it's increasing this year than it was last year. Maybe it's $400 this year. So you still have $400. If you have a loan against your policy to go buy yourself a car, you also are owing loan interest on that.
It's not growing at all.
It's not growing.
No.
And so you're double down in your account.
Risk. You have market risk.
Your market risk.
Yeah.
And so I can't use that as a product to be like a strong foundation to be able to be comfortable to take loans to pay my taxes or to buy a car.
Yeah, it wouldn't be used as a banking instrument.
No, you can't use it for banking because it's not something you can count on. There's too much risk involved. And I've seen people where they over leverage their IUL, they take loans every single year, max it out, and then they don't have enough to pay it back, and they have a ton of loan interest and no premium, and they lose the policy.
Yeah.
Happens all the time. And so there's unless you know how to use it wisely, I wouldn't use it for banking. But that's a product out there that people talk about using as a life insurance or as a diversification of their assets is in IULs. And you can do similar things with whole life, but with all guarantees in whole life, so it's more predictable and a better foundation to use. And there are some universal policies you can use as well. So in terms of all the insurance products out there, there's tons. How you should use them is based upon your goals and situation, which we recommend to do your own research into why you'd want to do certain things according to your goals and plans. But for what I teach, which is using whole life insurance as a vehicle to protect your assets or finance things from, we use whole life for that. We don't use any other product. Term insurance plays a role. IULs can play a role in other products too. What else would you like to add in there?
I mean, I would just say if this is a question that you're looking at or not sure about, contact Carson. And what I love about Carson is he's doing a phenomenal job of educating, giving content, and letting you make the decision what's best for you. So you're never going to hear from him, which I think is a very good strength that you've got, is educate, let people decide after they have the information. And you can't, it's hard to get just from Chat GPT or just from, because there's still a lot of different real human variables that do matter. And so I'd say get with Carson, obviously, and he can kind of educate you on these different types of insurances.
Love it. Well, thank you guys. We appreciate you listening today about life insurance and different products. We always have something new to share with you guys. If you want different topics from us, please DM us or comment on these podcasts wherever you're watching or listening, and we'll love to share whatever we can. So thank you guys for listening.
Let's do our sweet, sour, and service. My sweet, March Madness starts tomorrow. Super excited about it.
Yes.
My sour is I just did a CrossFit thing in competition and I got second place. I'm pretty sour about it because I worked really hard on it. And my service is bringing my son lunch to school. You didn't get this benefit because I feel like I bring Cash lunch to school, like Chipotle or Chick-fil-A or whatever, at least once a week. And I feel like
That's nice.
you didn't get that share of
No.
it. But anyways, those are my sweet,
No,
sour, and service. What about you?
Not. We'll just end real quick with the sweet, and I love March Madness too. I'm excited for that. But sweet, I will say, is I have some big clients coming through that I'm working with them on building their own financial plan, and it's been really exciting and fun to work on. So,
Awesome.
and it was a sweet. Thank you guys for watching.